Joining us with more insight, Ben Breitholtz, data scientist at Arbor Research and Trading. Ben, you look at Google searches and you scan hundreds of thousands of them and you categorize them into different areas and things related to shopping and consumption and going out and traveling. And you say that you're starting to see a little bit of signs that after a torrid pace of shopping coming out of the crisis or coming out of the lockdowns, starting to see a little bit of cooling off.
Correct. So a lot of both the going out and staying in topics, and that's everything from, hotels, flights on the going out, the staying in, everything from exercise equipment to food delivery. That began to abate in the end of March. So really March 28th was the pinnacle of that search activity. It's receded back towards its long run kind of average. That's done that kind of across the globe. And interestingly, and I think you noted this too, this has coincided with the break to lower yields in treasuries after one of the most dastardly boring environments and tight trading ranges that we had seen in history.
Okay, but that's just, what's the connection there, therefore? Like people seeing that, why see this correlation that you're currently focusing in on?
Yeah, I think that we were in a holding pattern, and investors are waiting for some news as to how long essentially the growth in consumer spending can persist, and then also on the flip side, how long can these bottlenecks, shortages, and the supply chain remain in disarray? So we have this supply-demand issue going on. All this demand, and we still have all this supply issue that's also then resulted in higher prices. So some of the correlation there, I think, has to do with the stimulus checks, which we're now removed from, coming out in March. We've seen the inertia behind search activity for a lot of these goods and services kind of abate after that maybe 4-week window or so. And the other thing too that's happening, like your prior segment on inflation, is prices have gotten quite elevated for certain products. That's specifically in cars and used cars, houses, and also large household durables. So if you look at the University of Michigan Consumer Sentiment Survey, you'll see that we have some of the worst buying conditions related to price that consumers are reporting. So there might be some apprehension given these elevated prices, and maybe we're also preconditioned to believe, especially in my age group and younger, that lower prices will be coming in the future.
Yeah, this is what I wanted to drill into a little bit further. I mean, how much of this some of this cool pushback is like, look, if I'm trying to buy a couch and I keep getting messages that it's going to be 6 months and it's super expensive, maybe I'll just take a break and come back and revisit the question in a year from now.
Yeah, and I think some of that is happening to a certain extent, and that kind of gets into the thinking, I think, in the younger cohort that I can wait it out, that this transitoriness of prices will come down. That's the environment I've lived in for my entire career and life. The inflation fear and maybe some of the bigger fear of rising prices that could cause more demand, it depends, is from the older cohorts. You have almost 50% of those aged 55 plus see this right side tail to inflation, of 5+% on a headline basis. So there is some concern there. The younger cohort hasn't gotten as concerned, but I think there is this now sitting on your hands waiting. And I think we've all heard plenty of anecdotes and stories about just how wild housing prices have gotten in specific areas, as well as the cost for getting a wash machine or going out and buying a new used vehicle. I think there is some hesitancy that is showing up in the data.
Talk to us about the data you're looking at, you're scraping from ahead of the Fed. It's not about always inflation. Their sort of mandate to a large extent at the moment is employment and jobs. And I mean, just from sheer anecdotal evidence, when I look on social media or look on TikTok and there's so many videos being made of people walking out the room, walking out their job, feeling that they want to quit at a moment's notice because there's so much more supply out there. What are you seeing, Ben?
We are seeing a strong labor market, and I think some of the dynamics between the recruitment versus actual job seekers is a little bit misconstrued. It seems like job seeking is coming back. We are seeing search activity get quite fervent for everything from part-time to full-time jobs, and that has been strong really over the past 1 to 2 months, which is fitting with the rebound we saw in payrolls last month. We're expecting that to continue into June. So we have this high level of job openings, 20+% higher than pre-pandemic levels. But I think, it's been the job seeking side that's been kind of hard to figure out. And it seems like that's getting better and better. And maybe that will take further and further wage gains that we've begun to see, specifically with some of the larger retailers and even online retailers. Maybe that's what it will take, but it seems to be working to a certain extent. And it seems like out of everything, the thing the Fed looks at the most, the job market, their most important mandate right now is doing well. And inflation, we'll see if that is something that will moderate, as you've just discussed. We've seen in terms of the commodity markets, we've seen a retreat to about 50% of the major commodities producing positive monthly gains. That's from 100% previously. So maybe this inflation story will begin to slow as well. And we'll see how consumers respond.
All right. Ben Breitholtz, data scientist at Arbor Research in Trading. Caroline.